CoreWeave opening today on the NASDAQ at $39 per share, the lower than expected pricing potentially signaling investor concern about the sustainability of that AI boom. For more, we're bringing in now James Cakmak, Chief Investment Officer at Clockwise Capital. James, it is good to see you. So let's talk about CoreWeave, James. The big debut today. I'm curious, James, what you think the debut and the reception to that public debut perhaps tells investors more broadly about that AI infrastructure trend in space.
Yeah, thanks for having me. I think it leaves a lot to be desired. We were following it earlier this week and got some of the subscription numbers early on, and it was underwhelming, to say the least. You would likely see something like this 10x oversubscribed a couple of days ahead of the IPO, and it was about a third of that, and obviously not a good sign for the tech appetite for tech more broadly. And then you see that underscored with the pricing last night for it. So a lot of question marks out there, and right now, as we see it, there's a lot more uncertainty than not. So we think 50-50 market at best, with likely a bias continued downward, absent some type of tweet or whatnot that puts a lot of these concerns outside of the scope.
James, my only follow-up question for you on CoreWeave, though, the more you kind of read about it, it does seem to be it's a different kind of name in business, James. It's unusual in some respects. Per Bloomberg, more than 3/4 of its 2024 revenue was generated by businesses with its two biggest customers. One is Microsoft. Right. I mean, it's high concentration there. I'm just wondering, it does sound sort of unusual as a name, as a business. And I'm wondering if there's any risks in trying to sort of extrapolate from this name to something broader.
Yeah, obviously it does have high concentration with its customer base. That level of concentration is not something that you see regularly. Certainly it's something to consider. But at the end of the day, they're still part of an ecosystem that's growing in a massive way, and likely has secular tailwinds that are going to last years from now. So, in a normal environment, I think that despite the concentration risk, there would be appetite for a name like this. But right now, there's just too much uncertainty around what are the sustainable growth rates of these AI names, these AI infrastructure names, semiconductor names. Obviously, CoreWeave fits right central to all of that, because their demand for their services is going to be lockstep for the demand for the ecosystem as a whole. So I think it just speaks to the broader uncertainty around the growth rates of the space versus anything specific to CoreWeave.
So that being said, James, it's Julie here. It's good to see you. So that being said, do you as an investor sit back and watch as we see the broader universe of AI-related names sell off, the large cap tech, et cetera? Or are you stepping in, maybe CoreWeave is a little too far out the risk spectrum within AI, but are you still getting into or adding on to other names within the universe?
Yeah, actually, we've been taking off risk for the last couple of weeks now. We still like the AI space. We're not going to be involved in CoreWeave anytime soon. But the way we look at it is you got to take a barbell approach right now. On the one side of the spectrum, you got to have your super defensive names, your commodities, your utilities, and whatnot. And for every dollar of that, we have something on the other side of the barbell, whether it be crypto, AI, semiconductors. So we're playing both sides. We see risk to the market for everything that's essentially in the middle, where you have earnings risk and multiple contraction risk. But we just don't know when the turn is. So you have to be involved, but just take a more defensive posture to the portfolio by balancing anything with excess beta with low beta, and adding hedges and raising cash where you can, and by selling into strength.
Sticking with AI, James, what did you make about these comments we got this week from Alibaba Chairman Joe Tsai? That got a lot of attention, and for good reason, James, warning of this possible bubble in the AI data center build out. And he said, I start to see the beginning of some kind of bubble. He said, I start to get worried when people are building data centers on spec. What was your response to those comments?
I took it as slightly hyperbolic. I don't really see a bubble in this space. There are questions around the growth rates of the companies providing the services to build out the infrastructure. But a lot of those estimates have come in. It's really now a question of risk appetite and the multiples that would be applied to these companies. So I think that the infrastructure needs to be built. There's tremendous demand for these services. I think the productivity boom you're going to see coming out of AI is going to be eclipse a lot of people's expectations. You know, that old adage that people tend to overestimate changes over 2 years and underestimate the changes over 10. I think that's as pronounced as can ever be today. So I don't really buy that much into the commentary around it being a bubble. It's more so, what are the sustainable growth rates and what are investors willing to pay for it? And right now we're just in choppy waters and just got to navigate the volatility.
So James, where are you guys adding? Where are you looking here that feels more defensive? Is that within tech? Is it elsewhere entirely?
Yeah, I mean, like I said, on the one side of the barbell, on the defensive side, commodities like gold, utilities, we think in healthcare names, I think will be safe havens. And on the other side, we're incredibly bullish on crypto. And I don't think you can overlook that. I think that's going to be a big major winner for 2025. So we're leaning into there. We like some of the AI trades. We're much smaller in NVIDIA, but we're still there. We're looking at the AI power companies like Oklo, I think, in small size, but I think that there's opportunities there. So really, it's just about taking a balanced approach. But right now, you got to play defense. Too many unknowns, and until we're on the other side of this, the good news is that a lot of this pain and volatility stems from the fact that it's self-inflicted. What we're setting, the administration setting, kind of the tone and tenure of the negotiations around tariffs and whatnot. And really, all we need to do is see what type of cycle are we going to have, because anytime you say, okay, we're on the next leg up, or on the next leg down, it lasts 2 days. You can't make a definitive call on what the next 2 weeks looks like, much less the next quarter. So really taking very short-term timeframes on things and capturing gains where we can, but also not losing sight of the fact that things can turn very quickly because it is self-inflicted. So maintaining exposure, but just being a lot more tactical and precision-based. That's what you got to be in this market.
Yeah. James, good to see you. Thanks for joining us.
Thank you.